Welcome to the monthly economic and market report with Richard Morey. Richard's going to discuss and comment on the December report from Secure Retirement, and I, as always, am looking forward to his comments. Welcome, Richard.
Thank you very much, Jeff. It's a pleasure. We're going to try a new format here, where after we put out the monthly report, we're going to have one of these calls where I can just talk about it and perhaps give some more insight or a little more depth to some of the topics in the report.
Outstanding. So to start off, I know that one of the big topics was surrounding the observations that you've made just recently about the correlation to what's happening in the markets today, actually November of 2022, and the year 2000.
Yes, I don't know why it came to mind, but when I was writing this month's report, it dawned on me, I wonder what happened in the year 2000, because it's sure been feeling a lot like that now, just from a stock market perspective. So I went back and I looked at the year 2000, and I found out that through the month of November, for the first 11 months, the stock market in the year 2000 went down 14.03%. And then I looked and found this year, the same S&P 500 index went down 14.1%, the same amount. I checked NASDAQ and tech stocks, and the NASDAQ index is the tech-laden index. I checked NASDAQ and saw it had gone down 35% in 2001, 30% this year. So the resemblance between the year 2000 and 2022 are hard to miss. Please note, we're only talking about the stock market because inflation kicked the bond market in the teeth this year. And so that was different. It was a much harder investment year so far for most people. The average investors lost 10 to 20 or more percent because not only stocks, but also bonds went down.
Yeah, you know, Richard, when you're looking at this situation with this eerie correlation, do you have, I'm sure you got a lot of thoughts on where you think this may be heading, at least in the short term.
This story about the stock market 2000 and today is a story, I think, of valuation. In the year 2000, the tech stocks, the big ones, were the most overpriced stocks ever. And guess what? They fell 35% in 2000. The next 2 years, they continued to fall until they were down 83%. The S&P 500 started down negative 14 the first 11 months of 2000, just like this year. They proceeded to keep falling until they'd fallen over 40% more the next 2 years. So that is the concern, is that we might fall in a similar pattern. Yeah. And thus far, it's going the same way it did then. Technology often, typically you would expect tech stocks to go down first. They're leading indicators because when the economy is going to grow, people buy semiconductor chips. They spend on technology when they anticipate growth. When they anticipate contraction, when they think the economy is going to go down, they get out of tech stocks first and fast, which they've done again this year.
So with this going on, and I think, you know, everybody has felt this year's market to one degree or another, but you must have several indicators or underlying economic, you know, factors you're looking at that you think is maybe driving this.
Yes. The big economic indicators this year have really been in a sort of no man's land. Inflation has made some things certainly grow faster than normal, artificially, you might say. Other things have grown a lot, have contracted. Inflation has really hurt certain companies, certain sectors. On balance, it looks like the economy has kind of just had its, nose above the line of the water so far this year. The The real big concerns really are the employment market. That's where the economic trouble is brewing. Now, I know the employment numbers continue to look positive, although in the report I talked about how it's highly questionable what those employment numbers actually mean. Still, if you look around, you can tell just walking around town, you can get a job on the low end. That's not a problem. The concern is the middle income, the professional, the business services, middle management America, the people making $100,000 to $250,000 a year, it looks like are getting ready to experience wave after wave of layoffs. They're not going to lay off the frontline workers. They can't even find enough of them. So low-end jobs look okay for now, but corporations are getting ready to cut, and there's only one place they can cut. So I think, by the way, we saw 120,000 layoffs in technology companies this year. 120,000. That's a huge number. In 2000, the layoffs started in Silicon Valley in technology, just like this year. They just then spread to the rest of the economy.
Yeah, it's just happening just like that. It's just unfolding in front of us. So for the clients at Secure Retirement that are in the tactical allocation portfolio, which is the majority of clients, how do you see the impact of all of this on the portfolio and what you're thinking about doing?
Yes.
It moves your thinking maybe about making or not making.
Developments have actually been quite positive for how we're investing. Now, I say that because thank goodness we've got a second asset class that's starting to do real well. For much of this year, all we had, as you know, were managed futures. That was the one type of asset that was able to weather the inflation storm. Well, a few weeks ago, all the markets in mid-October switched 180 degrees. Everything going up went down, everything going down started to go back up. Everything flipped. When managed futures funds, they're designed to follow trends. So when you have a very fast, short-term, 180-degree flip in the markets, they will start to go the opposite direction, which in this case meant they started to go down. They went down for a couple of weeks, and I looked at it looking for an alternative to add. Long treasuries looked like the answer. And so I hoped, enough in long treasuries to make sure that if futures kept being soft, that the treasuries would make more than they were to go down. And that's exactly what's happened. Since I bought the treasuries about a month or so ago now, they're up 10%. The futures have continued to go down, although less and less, and have steadied now. But any losses were more than compensated for by the treasury profits. So we acted at a couple of weeks after the markets flipped. That change was made. And like that, it has flipped us from losing a modest amount to having made over 1% in the last 30 days. So that kind of short-term attention and changing course, the right amount, that's what's required these days to properly manage money.
Just a question that popped into my mind, Richard. Hopefully you'll be able to address this. You know, the portfolio management you do is it's very active, and it is there's a movement and focus and attention paid continually to what's going on. I think still most investors out there are in some sort of more of a passive portfolio, whether it's index funds or, funds in their 401k that are just sitting, in other words, there's no active management. They're just rolling with the markets. What are your thoughts about that right now?
My thoughts, are that about 19 out of 20 of them are probably making a terrible mistake. If you have an investment discipline that says, I am a long-term buy and hold investor, this is how I'm good, this is why I'm doing it, this is how I'm going to do it, it's a discipline. I can get behind that. I think we'll do better than them in tactical allocation, but I respect it. And I've invested that way for people who, like that discipline. I got no problem with that. But that's not what we see in most accounts. What we see, they're just going with the flow. It's just going, they'll go wherever the crowd goes. There's no rhyme or reason to what they're doing. It's not a real discipline. It's just what everybody else does. Well, going with what everybody else does is a very dangerous thing to do right about now, and it probably will be for a while. This is not the time to close your eyes and hope it comes out okay.
Yeah, the Hope portfolio.
The Hope portfolio, I don't think it's going to work. And if you look at the study, if you study the flow of profits and losses in investment accounts, the buy and hold crowd actually doesn't do very well. It's not surprising. Anytime somebody does something without discipline, they kind of heard something about it. Their advisor says, oh yeah, we just buy it and hold it forever. Why? So I don't ever have to work. No, excuse me, because that's the way you do it, right? That doesn't sound like a discipline. Yeah. You can have, I don't care what discipline an investor uses, just so it will work if followed.
Yeah. Yeah, the D word, discipline, is kind of important, especially in this area.
Oh yeah, a year from now, we'll look back. That D word will probably separate them into the vast majority and the few that actually managed the money, did the job during this time period. If you do your job as an investment advisor during a time period like this, you can do really well. This is not a time to be afraid if you know what you're doing.
Outstanding. Well, Richard, that's I mean, I feel like you hit on some very important points. Is there anything else you wanted to add in this live report?
Just that anybody who's watching this, if you have any questions about any of this material, give Jeff or me a call. We're always happy to talk to our clients or people who are just interested about all this information. And it's a pleasure. Thank you.
Thank you so much, Richard. Take care. We'll see y'all soon, at least next month. Bye-bye.
Happy holidays.